What's up, everyone? Today I'm going to be breaking down one of my favorite strategies for generating consistent weekly or monthly passive income by selling put credit spreads, also known as a bull put spread. So, if you're looking for safer, smaller trades that still add up over time, you're going to love this. Now, I'm an option seller and I love to sell puts on stocks. However, selling puts on large cap stocks can require a lot of capital. So, how do we solve that problem? Enter the put credit spread. This strategy is especially great if you have a small account or not a lot of funds to trade with. I'm going to show you how to put the spread together, how to manage it, and how to manage the risk associated with this options trading strategy. Hi, my name's Gautam. I'm a former finance executive turned options trader, and I'm here to help you escape the 9 to 5 grind, like I did, with the power of options trading. So if you're ready to change your life, hit that like button, subscribe to my channel, and let's get started. Also, don't forget to sign up for my free options newsletter, link in description below. So first, what even is a put credit spread? A put credit spread is a bullish option strategy that involves selling a put option and simultaneously buying a put option with a lower strike price on the same underlying asset or stock. The goal here is to collect the premium from the sold put option and pay less premium for the bought option, resulting in a net credit or premium. Now, let's look at some of the benefits of selling put credit spreads. First one is limited risk. Your maximum loss is capped, unlike selling naked options. Second, consistent income. You can generate regular income by selling these spreads weekly or monthly. Third, higher probability of profit. When done correctly, this strategy can have a high chance of success and is actually one of the best small account options strategy to grow your account fast. So let's talk about why I like to sell put credit spreads on SPY. SPY tracks the S&P 500, meaning you're effectively trading the majority of the US stock market, not just one company. This makes it less volatile compared to individual stocks. Because the SPY is so liquid, the difference between what the buyers are willing to pay and what the sellers want is tiny. You don't lose much by entering or exiting the trades. Individual stocks, on the other hand, can have crazy earnings, misses, or even scandals that can cause 30 to 50% drops overnight. SPY, being a huge index ETF, almost never does that. Also, SPY moves in cleaner trends and respects support resistance levels better than some of the wild individual stocks. Next, let's go over to Robinhood and do a live example of how we would put the put credit spread together. So I have SPY pulled up on Robinhood. What we're going to do is go to trade SPY options. Then we're going to go ahead and go out 1 week. May 2nd would be this coming Friday. So we're going to go ahead and sell put. Now, it's really crucial you select the correct strike price because that dictates the level of risk you're willing to take on the trade. So let's look at the SPY daily chart and determine what is a good entry point to sell our put options. So I have the SPY 6-month chart pulled up on Thinkorswim. And if you look at where SPY is at right now, it closed Friday on 551. So let's look at some support levels where it would be a good entry point for us to put a spread together. I see some support right here at the 534 level. I also see some support at the 532, 530. Let's go back to Robinhood and see how much premium we can collect at some of these levels. Coming back to Robinhood, I have sell put selected. Again, we chose the expiration for this coming Friday. And coming down, we said good support level was 532. So 532 is 17 delta. When I sell put options, I choose a delta of 15 to 20. And in simple words, what that means is there's a 15% chance of this going in the money, or there's a 20% chance of this going in the money. The flip side of it is if you choose a 16 delta here, there's an 84% of this put option going in your favor. Considering it's a spread and spreads can be risky if not done correctly, I like to be a bit more conservative and go for a lower strike price. So if I come down to the 530 strike price, this is about a 14 delta, almost a 15 delta. It has a lot of open interest and volume. And again, if you look at the bid and the ask, there's 3 cent difference here in between. So that means it's pretty good. It's pretty tight. It's pretty liquid. That's why I like to trade on the SPY. So coming down, if we just select the 530 put, you could see that it would cost us $52,000 to just sell one put on the SPY, which is why a lot of small accounts are unable to sell put options on the SPY. So let's see how we can solve that problem. Initially, we did sell put. Now we're going to do buy put. So we came down and I am going to select the 525 options contract right here and add it. And as you can see right here, Robinhood shows that now we have a put credit spread, with the top being we're selling one contract of the 530 put and we're buying one of the 525 put options. So now you can see that the capital required changed significantly from the $52,000 to just about $500. So that is one of the biggest advantages of doing a put credit spread. Again, if you're a small account, this is the perfect way to, get into SPY and some of the large cap stocks that you're unable to sell put options on normally. Now that we have the put credit spread loaded up and set up in Robinhood, let's see how it would work. So if the SPY price continues to stay over our top sold put strike price, which is 530 at expiration, we get to keep the entire premium of $52. Now, to get this premium of $52, let's check out how much collateral we would need to do this trade. If we just hit review order, since this is a $5 spread, the 530 on the top and buying the 525 put option at the bottom, the $5 spread is $5 times 100 shares, which is $500, which is basically the collateral required for this position. So going back, if SPY continues to stay over $530 at expiration, you get to keep your entire premium of $52, which 52 divided by $500, that's almost a 10% return weekly, or, times 4 weeks is a 40% return, which is phenomenal. So as you can see in the diagram, as soon as SPY starts going below the $530 strike price, our losses continue to increase up here. You can see it goes from a negative 195 to 236 and to our max loss of 448 if it goes to your lower strike price or breaches the lower put option of 525 that we bought. So the best way to manage risk with the put credit spread is, as soon as you see that it's getting close to your top put, and if you think it's going to breach it, I would go ahead and close that option right there. If you have strong conviction that there is a high possibility that SPY would come back to 530 or higher close to expiration, then you could potentially wait and see how that plays out. But if it were me, and if SPY is about to breach my sold put strike price, I would go ahead and close the put credit spread right there and then. Some additional tips for risk management on a put credit spread are not playing a put credit spread when it's earning season, because the market can make big swings. You also don't want to open too many positions, as your risk keeps increasing with each added position. So for example, with one put credit spread, we are right now risking $448 to make $52. If we go ahead and make this 5 contracts, your risk now is $22.40, or if you go ahead and do 10 contracts, then of course you're making $519 a week, which is $2,000 a month, but your risk is now $44.80 per week or $44.80 per 10 credit spreads that you sold. So again, you're the best judge of how much risk is okay for you to take depending on your account size, and you should trade accordingly. So that's it for today's video. Selling put credit spreads on SPY is simple, powerful, and a great way to stack up consistent passive income week over week. Remember to stay disciplined, manage your risk well, and continuously educate yourself on the market conditions before entering into the trade. If you enjoyed this video or learned anything useful, please give it a thumbs up, share it with your friends, and leave your comments below with any questions or thoughts. I'm also curious to know where you're watching this video from, so put in your location in the comments below. Thanks for watching, and I'll see you in the next one.